This week in crypto didn't look important, but it was. While attention stayed on prices, institutions made quiet moves, payments, infrastructure shifted, and blockchain technology moved deeper into real finance. Here's what actually mattered. Story 1. Institutional behavior shift. The first story this week isn't about price action. It's about institutional behavior. This week, reports showed that JP Morgan is actively exploring expanded crypto trading services for institutional clients. That may sound incremental, but it's meaningful. Large financial institutions don't move quickly, and they don't explore new services unless there is sustained demand and regulatory clarity. This is part of a broader shift where institutions are no longer treating crypto as a speculative experiment, but as an asset class that needs proper infrastructure and access. What stands out is not a single product launch, it's the pattern. Institutions are becoming more selective. They are focusing on regulated access, settlement efficiency, and systems that fit into existing financial frameworks. They don't chase momentum. They position early, then wait. And when behavior changes before public narratives do, it usually signals a longer-term transition already underway. Story 2. Payments infrastructure moves forward. The second story this week centers on payments infrastructure. This week, Shift4 Payments announced the launch of a stablecoin settlement platform for merchants, supporting assets like USDC, USDT, EURC, and DAI across multiple blockchains. That matters because it shows stablecoins being used for real merchant settlement, not just trading. At the same time, Zebek Network announced that its payments infrastructure is now aligned with ISO 2022 messaging standards and integrated with traditional payment rails, such as the US ACH system. These two developments point in the same direction. Global finance is upgrading how payments move, how data is structured, and how settlement happens. Legacy systems were built for batch processing and delays. Modern systems are being built for real-time, continuous value flow. Crypto-based payment networks are no longer being evaluated as alternatives. They are being evaluated as components that can plug into upgraded financial rails. What matters here is not branding or short-term market reaction. It's that payment expectations are changing, and infrastructure is being built to meet those expectations. Story 3. Traditional finance deploys blockchain tools. The third story this week is about how traditional finance is using blockchain technology directly. This week's data showed the stablecoin market continuing to expand, now approaching a total market value near $300 billion. That growth is not driven by speculation alone. Stablecoins are increasingly being used for settlement, liquidity management, and cross-border value transfer. Financial institutions are deploying them where they reduce friction and improve efficiency. This reflects a broader shift. Blockchain technology is no longer being tested in isolation. It is being deployed inside real financial workflows, backed by real capital, and governed by existing regulatory frameworks. Instead of competing with the financial system, crypto infrastructure is increasingly being used to upgrade it. And that kind of adoption tends to happen quietly, long before it becomes obvious to everyone else. When you connect these three stories, a clear pattern emerges. Institutional behavior is becoming more deliberate. Payments infrastructure is modernizing. And traditional finance is actively deploying blockchain-based tools where they provide measurable benefits. This is not the loud phase of crypto adoption. It's the structural phase. And historically, the structural phase is what determines what lasts. If you want weekly crypto coverage focused on what actually matters beneath the noise, this series is built for that. Let me know which of these stories stood out to you most, and I'll see you next week.